What is a joint borrower sole proprietor mortgage? Getting a mortgage can be difficult, so it's so important that you understand all of the products that are out there and understand how they could potentially benefit you. So a joint borrower sole proprietor mortgage, or JBSP, is a mortgage where multiple people are on the mortgage, but only one person actually owns the property. So a lot of times this is used when parents are trying to help their children get on the property ladder, or if you have siblings that want to get on the property ladder together. This type of mortgage is a lifesaver for lots of people. The sole proprietor is the only legal owner and listed on the title. So the supporting borrowers can help with affordability, but they don't actually own the home. It's a good way of getting on the property ladder. And I think, in my opinion, it's one of the most underutilized mortgage types because a lot of people don't understand what it is. And some people don't even know that it exists. So why this matters? Getting on the property ladder is tough for first-time buyers. Now, don't buy into the myth or the lie or the marketing that you cannot buy a home. It's very rare that I'm unable to get someone a mortgage. In most cases, it's just that maybe I can't get them as much as they need to get the home that they want. Sometimes this can be easily resolved by them maybe looking a little bit further out. So the best bet is don't guess, don't think, don't talk to friends and family. Talk to a mortgage broker who can actually do an affordability assessment based on your unique circumstances. What tends to happen is people call me and say, oh, well, if I wanted to buy a house for this much, how much could I get? Now, that's a good starting point, but what I need to know is the specifics. I need to know SID, so your credit rating, your income, and your deposit. The best thing that you can do if you want to understand how much you can borrow or how much of a mortgage you can get is speak to a mortgage broker who will do an affordability assessment and then arrange an agreement in principle. You can then take that agreement in principle and search for houses that you can afford. Now, if you're a first-time buyer, remember, this may not be your forever home. This may be that first home that you fix up, build some equity in it, and then step up from there. So when people say they can't get on the property ladder, it's usually because either they haven't displayed the discipline to save the money to get up and running, or maybe as a first home, they're shooting a little bit too high. This is also where a joint borrower sole proprietor mortgage can offer a creative solution when you don't have that income. So maybe you have saved and put a deposit together, but you don't have the income to meet the mortgage that you would need to get the type of house that you want. Sometimes this is used when a parent or a family member wants to help without being a co-owner, as I said. So it's kind of like the bank of mom and dad. How does it work? So all borrowers apply for the mortgage jointly. So everybody that is going to participate in this mortgage is named on the application. So each person is going to need to provide the documents as if they were getting a mortgage by themselves. This is really important because although you won't own the property, you are going to be evaluated as a mortgagee. So this means that the mortgage is going to be assessed on the profile of the very worst person. So if one of the people on the application has some credit challenges, that is going to be taken into consideration for the entire application. They're also going to look at the age. So if you have someone on the application, so maybe it's a parent and the parent is in their 60s or 70s, that's also going to affect what you can get and the term of the mortgage. So there is a benefit in the additional salary or income being put on there, but there may be some limitations as far as the term. So the combined incomes are used to increase the borrowing power. Only the main applicant or the sole proprietor is on the title, and monthly payments are shared, but only one person legally owns the home. So everyone named on there is jointly and severally responsible for that mortgage. So you wouldn't want to do a joint borrower sole proprietor mortgage with someone that you don't have confidence in or someone you don't feel is going to meet their obligation. As a parent, you know your kids, you know if they're responsible or not, but this is a great way to be able to support them. This product is, as I said, probably one of the most underutilized products. Different lenders are going to have different criteria. So you will find that some lenders require the person that is named on the application along with you that they are a blood relative. But there are other lenders that they just need someone that you trust and someone that trusts you. So it can be a friend, it can be a family member, it can be a work colleague, it can be anyone that is willing to do that mortgage with you. Here are some advantages of the JBSP mortgage. There's an increased borrowing power by using multiple incomes, as we said. Only the sole proprietor is on the deed, so there's a simplified ownership. Only one person owns the property. Supporting borrowers avoids second home stamp duty, so you would want to check with a solicitor on this, but it can be a way of that person, if they already own a home, so if it's a parent, they have the property that everyone grew up in, and they now want to help the child or the siblings get a property, they don't have to worry about that second home stamp duty. It allows for family and friends to assist without being the co-owners, because not everybody wants to be a co-owner. We have to talk about some of the disadvantages. So this is the downside. This is the thing that people often want to know when they are considering doing a JBSP mortgage. So all borrowers are jointly liable for the mortgage debt. So that's an important thing to know. So if one of the individuals just decides that they're not going to pay anymore, the other individuals on that mortgage are now responsible for the entire mortgage. So it's not as if three people are on there and the payments are £1,000 a month, that one person is going to say, well, I'm only going to pay £333. It's not like that. Everybody is individually and jointly responsible for the mortgage. But in most cases, the person that is living in the home is going to make the full payment. They just needed assistance as far as getting their borrowing power up. So removing the supporting borrowers can be complex and may require refinancing. What that means is, let's just say you have a person who needs a little bit of assistance right now because they're starting their career, their salary isn't where it needs to be, but the intention is that at some point they're going to remortgage. When they remortgage, if they want to take the other people or other person off the mortgage, they're going to need to meet the affordability and lending criteria by themselves. So you want to have a conversation and you want to understand what the exit strategy is, at what their timelines are. You want to have some assurances if you're actually going into this on behalf of someone else. You want to have some assurances that there's a plan, that there's a solid plan to at some point get your name off there if that's what you want. Fewer lenders offer JBSP. Now, going to a broker is going to be great because a broker works with a lot of lenders. So the moment you explore this option, they'll be able to tell you which lenders are going to be best for you. As I said, some lenders will allow people that are non-relatives. Some lenders will only accept relatives. Defaults affect the borrower's credit score. So everybody on there. So if, let's just say, the mortgage goes into a default, it will impact everybody's credit score. So it's so important that if you're considering this, you're considering it with people who you know and who you trust. But also, this is where having the right protection comes in handy. So if you're taking out this mortgage, even with the best intentions, life happens. So if one person passes away, if one person was to contract a critical illness, by having the right insurances in place, it will mean that either the mortgage is paid off in full, or there's money coming in each month to cover that person's share of the mortgage or the entire mortgage. So when you're going into the discussion about joint borrower, sole proprietor, you should also be having a conversation around what protection policies are going to be put in place. Who's eligible? Applicants must meet the combined income requirements. So what that means is there will be probably a minimum amount that, as combined borrowers, they make, or they sometimes are minimum amounts that each individual needs to make in order to qualify for this type of mortgage. All borrowers undergo credit checks. As I said, it is assessed based on the person with the worst credit rating, but going to a broker, they'll be able to assess which lenders have which criteria to accept what type of credit issues. So someone might have CCJs or defaults. They may have had things in the past. What most lenders are looking for is that for at least the last 6 months, you've resolved your credit issues, everything is up to date. So even if you've had a CCJ in the past, they usually want to see that it's settled. But even if it's not settled, they want to know that as of the date of the application, that you've been managing your finances well for at least the last 6 months. Some lenders will look for 12 months, some may look for 18, but as a rule of thumb, I would say you want to make sure that your finances have been well managed for the last 6 months, which leads me to another point. Don't wait until you think you're ready to get a mortgage to speak to a mortgage broker. This is one of the biggest mistakes that I see people make. What people do is they talk to friends and family and people that aren't mortgage brokers to get advice and guidance. They go out, they find a house, then they decide to go back to a mortgage broker to get an agreement in principle. That's not how you should do it. You should speak to a mortgage broker about 6 months in advance of when you think you're ready. The reason for this is a lot of things that we can do as mortgage brokers to put you in the very best position to get the very best mortgage that you qualify for. These things take time. So if it's something credit related, so you've had a missed payment or a late payment, it can take 6 to 8 weeks to update on your credit report. You may not have the money right then to resolve that. So if you speak to a mortgage broker 6 months in advance and they can tell, then they'll be able to tell you and give you a blueprint on what you need to do for the next 6 months. It may not need 6 months, but at least by having that conversation, you can tidy up your bank statements. You can pay off any small outstanding credit that you have. You can make sure you don't have any missed payments. And another thing that I find happens quite frequently is when people pull their credit report from Check My File, they find things on there that they weren't aware of. I have a client that I was dealing with a couple months ago who had something on her credit file that she was completely unaware of. No one was chasing her for the money. It was just a small 300-pound balance that had been sitting on her credit report for about 4 years. This caused major problems for her because she was unable to get through to the company because she no longer had an account. She did eventually get it resolved, but we had to delay taking out that mortgage, which caused some financial problems for her because her interest rate had gone on to the standard variable rate. So the best thing that you can do is speak to a mortgage advisor at least 6 months in advance of when you're ready. Some lenders limit the JBSP to family members, as I said. Lenders often want to see how the sole proprietor will take over the mortgage fully in the future. So as I said, that's about your exit strategy. You should have a plan. Your mortgage broker will be able to assist you in putting together the right plan. Some things to consider. If you're unsure or unclear, despite the fact that your mortgage broker will have explained everything in detail, given you an illustration, you should seek legal advice before proceeding, especially for the supporting borrowers. So the person that's actually going to be the sole proprietor, they're in a position where, the deed is in their name. But for everybody else, if you're unsure or unclear, you should seek independent legal advice to make sure that you understand what the product is and what the impact is to you. You should understand the long-term implications. I've talked quite a few times about your exit strategy. So make an agreement with the person that is the sole proprietor to understand what timeline they're on as far as refinancing. It should be someone you know and trust, so you should understand what their career trajectory is, and you should know and have confidence that they will maintain the payments and they will have that exit strategy in place and execute when it comes around. Make sure that all parties are comfortable with the shared liability. It's a great product. JBSP is a fantastic product, but it's something that you want to have the right conversations with. It's something that you want to do with people you trust. It's fantastic for siblings that, just want to get out of the parents' home and get along and want to live together. So I can't say enough about this product, and I just wish more people knew about it, because I think if more people knew about it, more people would look into it. And in looking into it, you might find that it's not the right thing for you, but not knowing about it, you won't even have the opportunity to look into it. So what are the next steps? So it can be a useful tool for first-time buyers needing support. If you are one of those people and you'd like to speak to someone, my information is in the description. You can book a free consultation. I don't charge for a conversation. You don't pay for a conversation. I'll answer all of your questions. I can do a financial assessment on your behalf. That way you can know realistically how much you can borrow as an individual. And if we then get to a point where you find that you're unable to get the size mortgage that you would need in order to buy the type of home that you want, and you have a friend, family member, parent who's willing to have the conversation, I'll have the conversation with them as well and go through all the details of this product. Weigh the pros and cons. So think about it. Maybe if you were to stay at home for an additional 8 months and save, you may be able to do it by yourself. The pros are very, very strong, but so are the cons. So make sure that you understand the pros and cons. Speak to a mortgage advisor and a solicitor to ensure that it's a right fit. Have a clear path for the future and open communications with all parties. So you want to make sure that it's people that you will be able to talk to, ask questions, and ensure that the process goes smoothly and it doesn't ruin any relationships. Each month on the first and on the second Wednesday, we do these property chats. This is where we talk about products, mortgages, strategies that are all property related. We answer your questions. So if you are a first-time buyer, a property investor, or someone that just wants to understand more about how mortgages work, this is the place to be. Be sure to like, share, comment, and tell friends about our monthly property talk. I appreciate everyone listening, and we will see you next time. My name is Anthony Lindsay, and I've been in finance for quite a while. I'm here to answer your questions, and my details will be in the description. If you don't have a broker and you'd like to speak to someone, I'd love to talk to you. My name is Anthony Lindsay. My phone number will be in the description, and I've been in finance for over 30 years.